Are we in a bear market? The worst mistake that you can make in such a market is fight against the environment. High valuations remove the margin of safety from the market. Only a very small segment of sectors and stocks are holding strong, and it is a narrow market. So, which begs the question, where are we now? The Indian economy seems to be all dressed up. You have high GDP numbers, you have low inflation, and a lot of policy changes that are coming positively for the Indian market. But if you look at the market levels, there is a definite sense of unease. The headlines every day keep on swinging between optimism as well as anxiety. The broader or the large market indices like Nifty sort of seem to be stable at high valuations, but look underneath, there is real stress among individual stocks. So, a fair question that investors seem to be asking in this scenario is, are we in a bear market, or is it a period of correction after a very strong cycle? Now, this question matters quite a bit because it will influence the behavior of investors in the market. If we are in a bear market, then you have to go to capital preservation. But if we are in a correction, then you have to be more selective and patient. So, in this video, we're going to take a step back. I know that we are near the year end and it is a great time to predict where the market will go in the next year and what will the index level be. We're going to look deep inside the market cycle and try to understand that what is the evidence that supports that we are in a bear market and what rejects it, because that will help us decide how do we invest in the coming phases of the market. So before we go on deciding if we are on a bear market or not, let's try to understand what a bear market is. The textbook definition, if you go and look on Google or you ask AI, what it will tell you is that a 20% correction in the market is a bear market. But we have to understand, what a bear market is on a more structural level. A bear market, can be characterized by a few characteristics. First would be earning stress. You'd see that there will be a lot of growth slowdown as well as earning downgrades happening in the market. Second, you would see that the liquidity would be tightening, right? Imagine 2008, there was a big liquidity crisis. Rates would be hiked up. You would see balance sheets contracting as well as withdrawal of risk capital. And number three, you would see that the valuation starts being reset, right? So there are a lot more downgrades. People, downgrade the multiples, P ratios are downgraded, and investors start losing confidence in the market. Now, these three together, they rarely arrive at once. Some bear markets, you'll see liquidity is the big concern. In other times, earnings. And sometimes, all three come together and it's a grinding halt. So which begs the question, where are we now? If you look at the index level, it looks a little bit confusing. The large cap indices are not that far from their highs. The volatility is sort of contained and there's no visible panic in the large cap indices. But the market definitely is not a raging bull phase, right? If you're looking at small and mid caps, you'll see there is sharp drawdowns and prolonged periods of underperformance. If you even look at some high quality stocks, you would see that many of them have not gone anywhere for years and years. And, many stock breakouts, right? These strong momentum breakouts tend to fail instead of succeeding. And this divergence between the index performance as well as the stock level movements is a clue that something has changed. So the first thing to look at would be earnings. We can see that the margins have been quite strong, whereas growth has been weak. On the surface, corporate profitability looks healthy. Balance sheets are clean, free cash flows are high, and return ratios are at multi-level peaks. But if you look deeper, what you would see is that the revenue growth across corporates has stagnated roughly towards 10%, which means that this is not a cyclical exuberance. It is, a low trend growth in a low inflation environment. Why this matters is because high margins without accelerating growth can be fragile, right? There's a lot of optimizing that the companies have done to keep their margins at the peak, but demand is not picking up to support them. If you look at valuations, there's a lot of growth expectation that is built in, but the actual cues that will lead to that growth are still not visible. And in fact, if you looked at earnings in the past few quarters, there have been more downgrades and upgrades, and finding those earning upgrades is a tough thing to find. But is this a earning collapse? No, this is a earning stagnation. Bear markets sometimes do not start with falling profits, but they sometimes stop when profits stop surprising on the upside. There is definitely, a sense of some pessimism in the earning commentary. Valuations do incorporate a strong earning growth, but the numbers are still not as exuberant in terms of growth that we expect them to. Second variable that we look at is liquidity. The monetary policy is not tight. Rate cuts have begun both in India as well in the global markets, and liquidity operations are also supportive. So liquidity is a very important variable that defines the characteristic of a market. And the positive developments on the liquidity front are definitely encouraging. But the liquidity transmission has been uneven. What you'll see is that the credit growth has not accelerated as the policymakers are expecting. The risk capital is also very cautious. You can see the FII selling, which has been a little bit troubling. And talking about FIIs, they seem to be tactical, right? They are taking tactical bets instead of putting money directionally into the Indian markets. So in today's environment, we are not in a liquidity crisis, and a liquidity crisis can lead to sharp bear markets. We're not there yet, and the policy is definitely supporting high liquidity. But what we're seeing right now is that this liquidity is supporting survival instead of excess, pushing us in a bullish phase. And such an environment typically leads to sideways market instead of crashes. Now, the big concern that has been there, since the start of 2005 and even late 2024 has been valuations. And if you have to find the argument against complacency, that would be valuation. The market level valuations seem to be elevated. You can see the nominal GDP growth has not grown that much. The corporate revenue growth has stagnated, and the long-term earning yield is also not that supportive. Now, valuation is something, us being fans of momentum, we typically do not worry that much about. But, high valuations remove the margin of safety from the market. In an environment where there is no excess liquidity, right? There's no rate cut, there's no QE program in the US that's pushing in liquidity. When will stocks grow, right? Valuations are at their highs, which means there is limited scope of valuations to rise, right? So a stock trading at 20 PE would very rarely be re-rated 25 PE, right? So how does a stock grow? The earning growth, right? The actual earning growing for the stocks can only lead to price appreciation. And if earnings disappoint even slightly at these high valuations with limited liquidity, that can lead to correction. That's what we have seen in various stocks in the previous few earnings seasons. And this argument sort of also tells us that this is not, maybe we are not at the start of a bull market, right? In a bull market, what typically happens is that there is low expectations and very cheap valuations, and we are in a totally different situation right now. So we talked about earnings, we talked about valuations, we talked about liquidity. Another signal that we look at is the market breadth or the market sentiment as suggested by different indicators in the market. I talk a lot about the fear and greed index in my previous videos, and that is one of the signals that we have to look at. In a bull market, what happens is most of the stocks participate in the growth. There is a lot of new highs that are being met every day, and the sector leadership tends to be broad. But in today's market, the leadership has become narrow. Only a very small segment of sectors and stocks are holding strong, and it is a narrow market. If you, in fact, look at a few sectors, you'll see some bear market, in fact, happening, right? Look at IT and look at a few infrastructure related segments. They have corrected almost 30% odd from their peaks, and there is signal of a bearish sentiment there. This is not an unusual sentiment because we're late in that bull cycle, but it is a cause of some concern. Historically, we come out of this in two ways. Either, the market breadth improves, you see different stocks participate in this, strong index move. Or the second option could be that the index corrects to meet the weak broader markets. So far, to be honest, we are not seeing a clear sign of either direction, right? It's not a clear indication that there's going to be a lot of earning acceleration or re-rating, and there's no clear signal that the index is going to come down to meet the weak broader markets. We cannot, in fact, say where we go decisively right now. So, having talked about all that, let's answer the big questions. Are we in a bear market? The honest answer is, in fact, a little bit nuanced. We are not in a classical bear market where liquidity is going to collapse and earnings are going to be downgraded. In fact, we are sitting on some very strong corporate profits and very healthy balance sheets, right? Companies seem to be doing pretty robust and GDP is showing for it. But if you are looking at that phase of easy returns, that structural bull market where, anything and everything worked, we are not there, right? So in terms of the bull market of easy returns, no, we are in the bear phase of easy returns, which means that returns will be there, but they might not be that easy. This is a market where time is a cost. Also, valuation discipline matters. You have to be very careful about valuations, and following a strategy is more important than conviction. The worst mistake that you can make in such a market is fight against the environment. And the second big mistake that you can make is to believe that nothing has changed. So we are not in the bear market of the classical sense where, panic sets in, but we are also in a bear market of easy returns, which means that the returns are not going to be easy. So what type of market is it then? This is a market of capital allocation instead of momentum returns. When the demand is weak, the growth is scarce, and the valuations are elevated, the market stops rewarding expansion for its own sake. What it does is it differentiates based on companies who use their capital effectively and companies where earning growth is highly visible. So the only stocks that are going to win in this market, and there are stocks that are going to win, would be those stocks which use their capital effectively and those rare pockets where you're seeing earning growth. Now, if we were to ask you where to invest in this market and how do you find opportunities in the market, there would be three classical cases that will present you good opportunities. The first category would be the category of restructurers, right? What that means is these companies which are coming out of pain instead of excess. The margin is compressed, the balance sheets are being repaired, and the expectations are not that high. The bad news is priced in, the risk in that sense is asymmetric, and even modest demand and policy support can bring in a lot more improvement in these sectors. So how do you look for these restructuring companies? These companies might be in their depressed cycles or mid cycles. There might be a lot of balance sheet cleanup that might have happened, and valuations are not at their historic peaks. What sectors would fit this definition? Your consumer durables and electricals. In fact, if you look at this year, it has not been great for consumer durables and electricals. The margins are bottoming out, but the policy tilt is shifting towards consumption. That is positive for them. Secondly, if you look at chemicals, right? After China dumping and excess capex, these selective chemical companies are coming up from the bottom. And thirdly, a lot of industrials are in fact coming up after stalled order inflows where you can do selective buying. And returns here will be driven by operational improvements. Now, the second bucket where we think it might be interesting to invest, but you have to be cautious, would be the reinvestors. What that means is companies that want to grow and that are deploying capital aggressively, right? But obviously we know that the demand is not rising that fast in the economy, right? So companies who are doing aggressive capex, they are trying to grow fast, but there is also a little bit of risk of the demand not matching up with the capex. In strong bull markets, companies that are doing a lot of capex are aggressively rewarded, they become multi-baggers. But in weak demand cycles, that can also be a little bit of a risk. There are various companies that, in fact, we also invest into, which fall into this bucket. You see that margins are high. There's been a lot of capex and capacity announcements. There is very optimistic growth narratives, and valuations assume that the execution is going to be very smooth. So we, in fact, invest in a lot of companies somewhere in the consumer segment or chemical segment and related sort of segments where we think that there are certain buckets of companies trying to grow fast and doing good execution, and they definitely can be rewarding in this environment, but you have to be careful in certain sectors, right? Number one would be your power sector, where supply has driven fast but demand seems to be weak right now. Second would be some of the industrial segment which is synchronized with the private capex, and also a few stocks in the hospitals and auto segments where asset creation might be at the late cycle. The valuations, like I said, are in fact incorporating these projections of fast growth, and any negative news seems to have an impact. And it's a tricky place to be in, but I do believe there would be certain winners which will be reinvested that will come out in this market. Now, the third type of stocks where you can be in the current environment would be these rewarders, or where these mature businesses where you don't see a lot of reinvestment or a lot of capex because opportunities are limited, but there's a strong moat. The growth might be moderate, but they're shock absorbers, right? A typical characteristic would be high free cash flow generation, stable growth, disciplined capex, and dividend yields as well as buyback support. If we were to look at sectors today, I think banking sector, which is relatively stable fundamentally at a very good place, but maybe might not give you very strong growth, would be a good shock absorber. You won't see a lot of volatility in that segment. Secondly, IT, where the currency supportive free cash flow yields are high, could be another such sector. There's certain telecom sectors which will also fit into that bucket, and even certain FMCG pockets could be good shock absorbers in the current market. What you would see for this set of stocks is not explosive growth, but predictable growth. So while we see that a lot of investors come and talk about the index, right? Index being more stable and sort of becoming a blunt tool, we believe that in this market, stock selection, identifying sectors as well as capital discipline matters much more, because there's not going to be a broad optimism but selective opportunities. So macroeconomically, everything's look pretty, but we are in a stalemate, right? The demand is not that strong, neither in the domestic market nor in the global market. We are in some sort of a stalemate. And the global macro definitely speaks of that picture. So what would actually break this stalemate? What would help us escape this sideways, stagnant, sort of selective, narrow market? The first thing that could support is global growth and trade cycles, right? If there's a revival in global trade, Indian corporates will see strong demand, manufacturing, chemicals, IT, capital goods will see a lot more demand. But, right now, if you look at the markets, global growth is growing, but very unevenly. There's a lot of volatility. China is exporting quite a bit of their excess capacity, which is keeping global prices and margins low. And the developed markets definitely is resilient, but it's not accelerating at a very fast pace. So for this stalemate to be broken constructively, the global demand would have to absorb the supply instead of redistribute it, which means that either the capex in the US starts aggressively, or China focuses on the domestic consumption instead of flooding the global market with cheaper goods. Now, the second thing that could help is the liquidity regime, right? So either the demand grows or there is more liquidity that comes to the market. Obviously, liquidity is improving. You're seeing rate cuts. RBI has cut rates. FOMC meetings. The US Fed has cut rates. This matters because the risk assets like equities, they work well when liquidity expands. But right now, liquidity support is stabilizing instead of stimulating the markets. What could really help in this environment would be if the rate cuts came faster and quicker, the balance sheets expanded, and there is faster credit acceleration. If that happens, then the earning multiples would also increase, which means we'll have valuation support. The liquidity support that's coming right now is helping us prevent a bear market, but it might not be enough to restart the bull market as yet. Now, when we're talking about the Indian economy, currency becomes a very important thing to talk about right now. You're seeing Indian rupee cross 90, right? And that's not positive in any sense, right? Indian currency is weakening compared to the global peers. But sometimes, currency also supports certain sectors. So especially companies that export, for example, IT, pharma, chemicals will get some support because the currency is weakening, and as they earn money in the dollar, they will stand to benefit from a weaker currency. Secondly, a weaker currency can also sometimes give us margin stability because the global pricing power becomes a little bit weak. A weak currency right now will not support growth. In fact, it's not a tool that will bring back growth to India. It will definitely help certain industries protect their profits. But the actual growth, in fact, will come when the volume grows instead of these translational gains. The fourth thing that could help this market would be domestic growth. Right now, if you look at wages, they are quite suppressed. The consumption demand is selective. You can see the rural demand has not picked up that much, and urban demand is also patchy. The pricing power is very fragile, and capex is not being rewarded that much. Now, if the policymakers are able to stimulate consumption in the economy, services grow, construction grows, and manufacturing grows in the domestic economy, that could in fact bring us out of this stagnation. But until then, that growth would remain narrow. Now, the fifth thing that could help us, and in fact, I've given you a lot of options of coming out of the stalemate, is valuations, right? So either your earning catches up. We're seeing slowly over the past 4 quarters, earnings have become better and better. Now, if the earning catches up, there's an acceleration in earning that would help us justify the high multiples, and P ratios will come down, which will make India an attractive economy for foreign investors. And second could be if the prices adjust and the valuations come down in that way. So in an environment where demand is weak, if the profitability increases, if the earning increases, that can help adjust the earnings. So out of the 5 options that I told you, number one, global growth coming back. Number two, global liquidity coming back. Number three, the currency serving as a support, or domestic demand coming back, or valuation being reset. Until unless a few of these factors come together, the market is going to be in this slightly choppy phase where we don't know what works next. And the selective ways to select stocks based on some of the growth drivers, the capex guys, or stocks coming out of their low margin cycle or going to the safety of the large stocks, could be the way to go in such an environment. What you would notice is that while I'm not giving you some very optimistic narrative in this video, this is not pessimism at all, right? We are not pessimistic about opportunities. And in fact, as asset managers, we are quite excited about such an environment because in such a narrow market, it really rewards people who are able to select the limited set of stocks where the growth is coming. So it's a more interesting market for a stock picker. So there is no pessimism in our narrative right now, but in fact, there is a lot of realism. So as investors, how do you respond to this market? Like I said, we are not in a bear market, but we are also not in a market of easy returns. What you have to do is, number one, correct your expectations. If you are going to expect a 70% returns of out of your small cap portfolio right now, that might not come true. And chasing such expectation can in fact lead to more whipsaws, right, which can affect your portfolio. Second thing I would say is narrow your universe. Anything and everything works in a bull market, but in a market like we are in right now, every stock will not work. Narrow your universe, finding that focus sectors and focus stocks that you have to focus on. And I gave you a lot of hints in this video, would be much more helpful. Third, I would say is while certain sectors, are better, right? For example, I talked about banking, I talked about certain defensive sectors, right, which are attractive. Getting into those segments at a wrong price can be detrimental. We have a lot of recent examples, in fact, to go with. You talk about some of the e-commerce plays, to name a few, for example, Eternal, or, if you're looking at some consumer durables like Dixon, these are attractive companies in good sectors, domestic focus, defensive sectors. But if you bought them at a wrong price, that can in fact be very disappointing. So, this is a market where, you don't have to be very heroic. You actually have to be patient and selective, looking at the fundamental, looking at the valuation, looking very, very closely at the earnings, and that will help you get a much decent sort of returns from this market. So as we reach the conclusion of the video, the bottom line is that we are not in a dramatic bear market, but we are not in an all forgiving bull market either. We are in a market that demands discipline. We're in a market where adaptability is key, right? You have to adapt, shift your exposure to sectors which are giving you opportunities and understand the nuances of the demand environment, the profitability, the valuations, and that will help you keep your capital intact. Also, the sectoral cycles or thematic cycles in this market might not be very, very loud, right? So over the past few quarters, we have picked some very interesting sectors that have worked for us, but the signals don't come very loudly, right? We don't take an effective call, okay, this sector now, but slowly we see those stocks creep up and start hearing the whispers before the sector takes off. So you have to listen to the whispers coming from the market, from the earnings first, and also from the price support. So this seems like one of the moments where fortunes are not made very quickly, but being disciplined, following the fundamentals as well as valuation can keep you prepared for when the next cycle begins. If you like this video and if you would like to see more such videos from my team, please hit the like button, share it across on your social media, subscribe to our channel, write down in the comments, what you liked and what you would like us to talk about next. Till then, happy investing, a happy new year, and we'll see you next time soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.